Let's talk then, Ray, about the limits of money printing. How long can this continue before central banks do run into the limits of their capacity to explode, as you say, the balance sheet and print money?
Well, the limiting factor has to do with the demand for that money and debt. In other words, what debt is, a bond, is a promise to receive a lot of currency. And so when it gives no good return or a bad return, and there's a printing of a lot of currency, clearly it's not desirable relative to other things for private investors. However, the central bank can buy it too. And so the limit has to do with the limit of demand. And that limit of demand has to do with the central bank's purchases of that, because they could buy it and hence there's no problem. So you look at periods of time of where in history, where was the most of it that has ever taken place, and to try to define the limits. And the war years was an example, or I think the most analogous period we're in now was 1930 to 1945. I'll explain the various ways that it was analogous, but more importantly, I'd like to deal with the question of the limits. And so you first had the Depression, and in that Depression, and when you hit zero interest rates, you had the printing of money and the buying of financial assets, and then you had a lot of fiscal policy, so programs that produced large deficits, which then were monetized by more of that. And then you went into the war years, and the war years, very similar to now in terms of the need for a lot of money and credit, produced an enormous amount of money and credit, but it was managed by the central bank in a way where they were de facto taking that on, and it produced, it was a good example of testing the limits of that. Now, we went into periods where, what is an alternative source of wealth? And as I say, it could be stocks, gold, it could be other assets. But those became the boundaries. What would happen in terms of this limit is if something transpired where the dollar as a reserve currency, the holders outside, made another market that was a better market. It could be gold, it could be stocks, or it could be an alternative currency, like we in the earlier session, which I listened into, China as a reserve currency. There will need to be an alternative process. When that happens, and I think it will happen, it looks like a currency defense. What I mean by currency defense is if money leaves that asset, if those who are holding bonds don't want to hold the bonds because they have lousy returns and they're printing a lot of money and they want to go to something else, and that starts to accelerate, should that happen, then what that does is as money leaves, it puts the central bank in the position of having to decide whether it buys more bonds in order to fill in that gap, or it lets interest rates rise. Well, they can't let interest rates rise. There's too much debt, and then also interest rates rising means that the asset prices all go down, and it's too vulnerable. So like all currency defenses, what it means is that they then have to accommodate that. And the act of accommodating that in and of itself is a big problem. Should that happen, that would be terrible for the United States. Earlier I heard about the discussion of the privilege. That's right, the United States dollar is a tremendous privilege, and we are certainly pushing the limits of that. And if we were to think that the dollar was to be any other currency because of us pushing the limits, if that were to happen, it would be probably the biggest disruptor, not only to the markets but to the whole world geopolitical system. So We're in a fiat monetary system. What I mean is through history, throughout most history, there was gold. Let's say 1944, we create the Bretton Woods system linked to gold. The United States printed a lot of money and more claims on gold than there was gold. And in 1971, which wasn't very long ago, we couldn't meet those claims on gold because we had too many IOUs. So we had a devaluation. And the dollar as a world's monetary system or currency is critical. But it very much depends on the dollar, the United States competitiveness, and so on. So it's a longer term risk. As Nouriel was pointing out in the earlier session, one of the things that's been a prop for the dollar is the fact that there's a lot of dollar denominated debt. So what that means, it creates a demand for dollars. That debt will either be satisfied in some fashion or another because there'll be the dollars to produce it, or that debt will be defaulted on in one way or another. That's a whole other discussion we can get into if you want. But at that point, it'll reduce the desire, the short squeeze for dollars, which will serve to weaken the dollar at the same time. And also, as we look longer term, as Nouriel was pointing out, the squeeze, the politicalization of it, changes the nature of the capital flows because we are in a situation where you can be squeezed. And so when you start to think about, yes, if you're China and you're owed, you're holding $1 trillion of treasuries, would you want to do that? Well, particularly, given the returns, given all that, and given the conflict. So this China piece is a part and piece. I'd say there's three things. We're spending a lot of time discussing the monetary and debt cycle. The second is the what I'll call the gap, the wealth gap, and the values gap cycle, and then the third is China. So if we look at those things in combination, I think that's the best way to look at the whole picture.